Are you thinking about buying a home, but you're waiting for those mortgage interest rates to come down? Everybody knows that a lower rate and makes for a lower payment, and that's easier for buyers, right? But it is a lot more complicated than that, and you're about to hear why. I'm going to cover some exciting new loan options, why continuing to rent may cost you more money even if your rent is less than your new mortgage, and how investing is a great real estate option for long-term wealth building. Welcome to House Talk on KAFM 88.1. Each month I bring in local experts to talk about real estate topics that matter to home buyers and sellers in Mesa County. I'm your host. I'm Kate Porras, a realtor at RE/MAX 4000. So a lot of buyers are being hesitant right now to take that plunge, to make the leap, to go in and say, yes, I'm actually going to purchase. And we keep hearing, I'm going to wait for rates to come down, or I'm going to wait for this or that. That may actually be hurting you. And we're going to talk about that right now with Jim Kaiser, a senior loan officer with Guild Mortgage, in the studio today. Jim, thanks so much for being here.
Yeah, thank you.
So we kind of chuckled. As a loan officer, how many questions about mortgage interest rates do you get on a daily basis?
Well, we were joking earlier, never, but actually it's the most common question.
Yeah.
And it's a little short-sighted in my opinion, because most loans are a 30-year loan, but the average loan only lasts about 10 to 12 years.
That's because people either refinance or they move.
Exactly.
And 10 to 12 years is actually up from what it had been just a few years ago. It was closer to like 5 to 6 years. So it's people are staying in their homes a little bit longer. But even still, very rare to have someone stay for the full length of a loan of a 30-year mortgage.
Very much so, yeah.
Yeah. So a lot of people are like, well, what are the rates today? What are the rates today? What are we looking at right now?
So as of last month, the average 30-year fixed rate was 6.64%. Rates did fall at the beginning of the first 2 months of this year, as low as 6%, but they bumped back up. So right around mid-sixes today.
So I was doing some looking back on my own personal life. Bought my first home in 2002, and my rate at that time, just under 7%. Ironically, maybe a little bit higher than where we are today. So people keep hearing, oh, these rates are high, these rates are high. Are the rates really high?
Actually, no. The average rate since 1971 is about 7.75%. With a record high of 16.6% back in 1981.
Thank goodness we're not there. Nope.
But with recent averages around 6 to 7%.
So are we expecting that to change?
The forecast right now is it's really going to remain largely stable, anywhere between 6 and 6.5% through the rest of the year. Currently.
And I've even seen some long-range forecasting, even over the next couple of years, and a lot of people are saying, no, this is probably where we're going to be for a little while. Do you agree with that?
I would agree with that, and don't rely on the Fed rate, because everybody always looks at the Fed rate and thinks that impacts mortgage rates, which it does not.
Right. Yeah. It is. Do you want to explain that real quick? Because that is something that we hear in the news, the Fed rate, but that is something different than mortgage interest rates.
It used to be so simple to calculate future on mortgage rates because it was the bond market, the 10-year treasury, et cetera. So there are factors that come into play that could affect the mortgage rates, such as inflation and all these other announcements that come out on a daily basis now. But the Fed really focuses more on short-term, like one-day financing, whereas mortgage rates are more long-term.
Right.
Yeah.
I know you're really good at explaining, because you've done it for me before, with why is it not necessarily a good idea for rates to drop? Let's say you're in the market, you want to buy a home, but you keep saying, no, I'm going to wait for that rate to drop. Why is that maybe not a good idea?
Perfect example is the COVID years.
Yes.
When rates dropped to 2-3%, guess what? It brought a lot more buyers into the market, and all of a sudden you were competing. Therefore, home prices went up because people could offer a higher price. So it's better to do, this is the perfect time to be buying, because you've heard the old saying, right? Marry the home, date the rate.
Yep.
So once rates do drop, you can always refinance later if need be.
Or if rates go up, that's a possibility too. You're still, people think, oh, they only can go down, right? No, they could go up.
They could go up.
Waiting even till then might not be in your best interest
either.
And you're losing out on all of that equity too when you actually own the home. We have a lot of people that are looking at options. And I have been getting, especially recently, a lot of messages, calls from different lenders, different companies. And it sounds like lenders are hearing what buyers are saying, that it just doesn't feel affordable. So they are bringing back some old tools that have existed but maybe haven't been used very much recently to try to find ways to make it feel more affordable for buyers. I know I talked to a lender just this week, and they have the Community Reinvestment Act is what their product is, and it takes out mortgage insurance. So that's an extra part of your monthly payment, so it lowers the monthly payment that way, and they were able to offer some lower rates. So that was one way that they were keeping it down. I've heard from a couple lenders bringing back the ARM, which I know you guys are doing that as well. Explain, what is an ARM? How does that work?
So I've been in the business for over 28 years, and I've seen all types of loan products, but adjustable rate mortgages have really not been attractive for the last few years. However, we are actually partnering with Belco Credit Union, and they're now offering what we call as a 7-1 ARM, which means it's locked for 7 years. And that rate right now, depending on your FICO score, could potentially be as low as 5.5% at par, which means you don't pay any points to get that rate. So amazing rate.
So what does the 7-1 mean? How does that work?
7 means that it's locked for 7 years. It does not change.
Okay.
After the 7th year, it could change on a yearly basis.
So each year it could change after that?
Correct.
And does it automatically mean that it's going to go up?
No, doesn't mean that. I mean, 7 years from now, who knows where the index will be at that time. It could stay the same. It could be lower. It could drop. It could.
So I actually, going back to that historical, looking through my history, that first house that I bought, we bought it using an adjustable rate mortgage at the time. We knew that there was a good chance that we wouldn't be in there for the length of that. I think ours was a 5-1 ARM. I can't remember exactly. And it was an opportunity to get into the house at quite a lower rate, which made our monthly payment more affordable. Obviously there's always pros and cons for all of these different types of products. What the pros, obviously a lower rate, which means a lower payment. What are some of the cons, some of the things that people also need to consider? So
I always ask people that are considering an adjustable rate mortgage is, how long do you plan to stay in the house? So I've had some people tell me that, well, we're only going to be in this house for about 3-4 years. So if it's a 7-1 ARM, it's a perfect product for that because they're only going to be in it for 3-4 years. If they say, no, this is our home forever, and we want to stay in this house and we don't want our payment ever to change, then possibly you want just a traditional fixed 30-year loan instead of adjustable rate.
Yeah, but as we were talking about, the average time that people are in their homes is about 10 years right now.
Right.
So if I do get an adjustable rate mortgage and I get close to that time where it's going to start affecting whether the rate might change, do I have to stay with that loan or can I refinance?
You can always refinance.
At any time?
At any time.
So if the rates go down, you can still, even before your ARM limit comes to an end, you could still refinance then?
That's correct, yes.
Or any time afterward?
Yes. I mean, there might be an adjustable rate mortgage program out there that requires you to keep it for a certain period of time.
Okay.
But for those that I know of, there's no requirement that you have to be in it for a certain period of time.
So why are they becoming more popular now? Because they weren't for years.
That's a great question. I just think we have the relationship with the credit union, so maybe they're looking for different creative ways to get people into homes and make it more affordable for them. So it's a great program. We're always talking about, right, affordability.
Yeah.
So another way to get people into a home that can qualify.
You're listening to House Talk on KAFM Grand Junction. In the studio today, Jim Kaiser with Guild Mortgage, a loan officer. We're talking about different ways to try to make things more affordable for buyers, but also helping them realize that they might be missing out if they're waiting for things like the rate to come down or whatnot. I know that there are different ways. Are there ways that people can kind of figure out how much their mortgage payment would be based on different interest rates? Are there easy tools? Those tools that you find online, you click on every kind of website and they're like, hey, we'll tell you what your mortgage is. Are those accurate? Are those easy ways to tell?
There's if you go out and Google how to mortgage calculator, you're going to find all kinds. But I'll say if you go to my website at jimkaisermortgages.com, we have mortgage calculators there.
And are they pretty accurate?
Yes, they are.
Do you have to put in a lot of your personal details for it?
Nope. You can just put like the purchase price, the loan amount, how much you're going to put down, and then you can put in the interest rate, and then you can say, well, what if the rate is this versus this, and it'll calculate the payment for you.
And if the rate changes a little bit, how much difference is that going to make in a payment?
Great question. The general rule of thumb I use, and this is a little different than rate, But for every $10,000 you put down more, or the house price is more, $10,000, it only affects your payment by about $63 a month.
Okay.
So it's not a lot. People always think, oh, if I put an extra $20,000 down, it's going to save me a lot. But it may only save you $120 a month.
Okay.
Yeah.
And so down payment, the amount of down payment, you really need to factor in how that's going to affect you, and probably speak with someone who actually knows what they're talking about to make sure that you're getting that accurately too. Right. You always want to look at, you don't want people to be cash poor when they move into the house. So if you can save them money, they don't have to put as much money down. Matter of fact, people often say, I want to avoid mortgage insurance, so I'm putting 20% down. But putting 15% down, their mortgage insurance, if they have great credit, could be as low as like $35 a month. It's not a lot. Okay.
Yeah.
And there are so many different programs now too. I know people that may not have a bunch of cash sitting in the bank that they can put down on a home. There are so many programs out there to help people with that down payment, or you don't even, I know even you can do some conventional loans that are not the full 20% as well, correct?
Right, correct. There's many different down payment assistance programs, as you're probably aware of. There's CHAFA, Housing Resources as well, that can help you with more of your down payment.
A lot of great information. We could talk about this for literally all day long and still probably just be scratching the surface. But Jim, if people have more questions, how can they get a hold of you?
They can reach me at my office number, 970-256-0080.
And if you are thinking about going out to buy a home, get in and get pre-qualified with a good local lender so that you can know exactly where you need to be shopping to. That's so important. I still have buyers that don't think that they should be talking to the lenders yet, but that's really your first thing to do.
Oh, and if you're 6 to 12 months out, it's the perfect time to meet with a lender because they may have a game plan for you or what you should be doing to build your credit. Sometimes it might include go out and open up a credit card, which will build your FICO score.
That's a whole new topic.
I know.
Jim, thanks for joining us today. Appreciate you being here.
Thank you. Good to see you.
This segment airs on the second Wednesday of each month. You can also listen to podcasts on demand at KAFMcommunityradio.org. And make sure to join us next month for another edition of House Talk. If there's a specific topic you'd like me to cover, give me a call at 970-985-8555. You can also visit kateporras.com.